Hello and welcome to Quarterly Perspectives Q1 2024. This is Ryan Mahoney at Cypress Asset Management. Today we will look at quarterly equity and fixed income performance along the framework of absolute returns, relative returns, and future expectations for market performance. We will then go on to discuss recent interest rate movements and inflation expectations. Lastly, we examine how different asset classes contributed to an overall portfolio return. We hope that you enjoy today's presentation. Now let's get started. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from the illustration here, U.S. developed, international, and emerging stock markets were all up for the quarter, continuing the positive trend from the previous quarter. Returns for U.S. bonds were slightly down for the quarter, and global bonds were up for the quarter. However, bonds are up for the year, both domestically and internationally. Next, I'll draw your attention to the upper right-hand portion of the graphic here. The U.S. dollar was up 3.1% for the quarter and up 1.9% over the last 12 months. Now let's take a little deeper look at what has been driving the returns of stocks and bonds. We'll start by taking a look at how global equities performed for the quarter, and we will isolate the performance between U.S. and developed international stocks. The two charts here show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with Russell indices, and international market returns are measured with the MSCI World ex-US Index Series, which represents, of course, global developed market performance excluding the U.S. As we can see from the dark blue line on the chart on the left, the U.S. market was up 10% in the first quarter compared to up 5.2% for developed international markets on the chart on the right. Large neutral stocks and large growth stocks on average outperformed the market in the U.S. Large growth stocks led the pack domestically, which is a new trend from last quarter on a relative basis. Internationally, large growth stocks and large neutral stocks tended to outperform the market as well, with international large growth stocks posting the best performance for the quarter among international developed regions. But no matter the recent trends, it's important to remember that we should not make longer-term projections based on short-term performance. Now we take a longer view to see how different investment styles have performed for standard periods ending March 31st, 2024. Looking at annualized returns in the U.S., we can see that markets have shown resilience, especially over the trailing one-year period when faced with significant headwinds, such as an ongoing war and geopolitical conflicts outside of the U.S., as well as uncertainties surrounding the future path of interest rates, and, of course, an upcoming U.S. presidential election. Despite these potential issues, U.S. markets have returned 29.3% over the last year and have been nearing or exceeding now 10% per year during the longer time horizons. Large growth stocks have the best performance for the trailing one-year period, gaining 39%, which beat the U.S. market by 9.7%. We can also see that small and value stocks have generally been out of favor during these same time periods. Consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for our clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. However, keep in mind that the very long-term evidence does demonstrate that on average, small stocks outperform large stocks and value stocks outperform growth stocks. But size and value factors can still go through extended periods of underperformance like those just shown above here. Okay, turning now to international markets, we see that large cap value stocks have led the pack over the one-year period. The longer time horizons, we see varying performance among different styles with value stocks, large cap stocks, and growth stocks, each posting leading performance over the trailing 3, 5, and 10-year periods. Relating to the prior slides, we see that international markets have underperformed the U.S. market by 14.7% during the last 12 months, as well as at longer horizons with the 3, 5, and 10-year performance trailing by 5.7, 7.2, and 7.6% respectively. Now, given the higher U.S. return over longer time horizons, We would expect portfolios concentrated in U.S. stocks to have outperformed a globally diversified portfolio. However, as we will see in the next slide, these relative performance numbers are not reason enough to abandon international stocks altogether. Okay, thus far we have discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market valuations and how they relate to future expectations of market performance. The charts here show how expensive stocks are by a measure of the price-to-earnings ratio, or P/E ratio, a very common metric used to value equities. The higher the ratio is, the more expensive the asset class overall. Or thought of in another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total U.S. stock market costs roughly $23.50. Internationally, as we can see in the chart on the top right, earnings are cheaper, just over $15 per dollar of earnings on average. The values represented here use the historical fund and ETF data to establish the price ratios, and the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for U.S. stocks and in the fourth quarter of 2006 for international stocks. Noting the strong market performance during the last 12 months, we see both broad U.S. and international markets are now trading above their recent historical averages. We can also see that small value stocks in global developed markets appear cheaper relative to their recent historical averages. All else equal, we'd like to pay less for a dollar of earnings. Now, these valuation ratios help in setting expectations about the future. Low valuations today imply higher future returns and vice versa. The recent strength of broader U.S. market performance means that it's reasonable, but not guaranteed, but reasonable to expect lower returns than in the past when valuations were below their long-term historical averages. The opposite is true for international markets and small value stocks globally. And it's reasonable to expect higher returns than in the past when valuations were above their long-term historical averages. I will emphasize that this is a long-term relationship and that short-term outcomes will likely be dominated by unexpected market forces. Okay, here we have the same analysis but isolating U.S. equities so that we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year run. We can see that growth in the prices has exceeded the growth in earnings as the P/E ratio has climbed to 33.4 to close the quarter, which is above its long-term average since 2004. Small value, on the other hand, still has a P/E ratio of 11.6 and remains under its average since 2004. Now, although many investors may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we'll take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing in inflation. The charts on the screen show the average performance of different bond maturities at the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left side, we see that bonds have longer-term maturity ranges and negative performance, but markets favored shorter maturities relative to intermediate and longer maturities, with the 10 to 20-year segment posting the largest loss because of their increased sensitivity to rising interest rates. The chart on the right shows the performance of different intermediate maturity credit quality bonds. We see that performance was mixed across the different credit qualities listed for the quarter, with investors favoring corporate and inflation-protected securities relative to other credit segments. Next, let's take a look at the Treasury yield curve and what it means for returns going forward. Here we plot the yield curve to show the current yield for Treasury bond investments at different maturities. The light blue line represents current rates, the dark blue line represents rates from the end of the prior quarter, and the gold line represents rates from 1 year ago. With the exception of the ultra-short-term portion of the curve, rates increase for all maturities during the quarter. As stated previously, this trend has a more negative impact on longer-dated maturity debt. Looking forward, expected returns for fixed income remain elevated relative to the pre-pandemic era and have increased during the prior 12 months. For long-term fixed income investors, this is likely to be a net positive as new money in maturing bonds are reinvested in higher-yielding bonds. The yield curve as well remains inverted as it was at the end of last quarter, although less so than this time last year. And when this happens, particularly between the 2 and the 10-year points in the curve, it's widely regarded as one of the precursors, but not as a guarantee to an impending recession. Finally, we plot the market's forecast of inflation by taking the difference in yields between the U.S. Treasury bonds and TIPS at various maturity levels. Like the last chart, the bright blue line represents current inflation expectations. The dark blue line represents inflation expectations from the end of last quarter, and the gold line represents inflation expectations from 1 year ago. Current market estimates for future inflations are slightly elevated compared to the prior quarter, but are little changed compared to this time last year. Even though inflation readings have continued to moderate, the Federal Reserve has been persistent in its stance that it's too early to declare victory over inflation, because its 2% inflation objective has yet to be met, and as such will need to show evidence that inflation is able to stay at that target in a sustainable manner. Even with that being said, Fed Chairman Jerome Powell stated in early April that it's still reasonable to expect the Fed to begin cutting rates this year, as the risks of re-accelerating inflation and keeping rates elevated for too long are continuing to balance out. As of the end of the first quarter, markets have downgraded their expectations for the number of rate cuts in 2024 from 6 to 3 for a total reduction of 0.75% or 75 bips. And that's in the federal funds rate, with the earliest cut occurring as early as the Fed's June meeting. But as these expectations continue and always to change, it's important to remember that these levels of inflation are baked into prices today. Markets are pricing an average inflation rate of approximately 2.4% per year for the next 5 years, and the market collectively expects inflation to similarly outpace the Fed's target over the next 30 years. Not only are these expectations baked into bond prices, but they're also baked into equity prices. Making a bet on higher inflation would mean that we expect inflation to exceed the current forecast. Next, let's take a look at how some major asset classes contributed to a 60-40 index mix this quarter and how that index mix behaved during recent history. Okay, on this slide, we look at the absolute impact of different asset class returns on the quarterly return of a sample 60% stock, 40% bond index mix. Stock markets moving upward this quarter and bond markets being stagnant. We can see that equity asset classes contributed to an overall increase of the index mix. U.S. large-cap stocks were the largest contributor for the quarter, while U.S. intermediate bonds detracted slightly from the overall return. Diversifying stocks across geographies and investment styles, as well as allocating to bonds, helped avoid undue portfolio concentration risk while allowing for substantive growth this quarter. This resulted in the 60-40 index mix achieving a return of 4.3% versus the U.S. total market return of 10%. The portfolio was able to achieve 43% of the stock market's return while only being exposed to 60% of the stock market's risk. That's the 60-40 index mix. Okay, here we see a collection of major asset class calendar year returns displayed on a quilt-like chart. Looking at year-to-date returns in the rightmost column, we see that all asset classes, with the exception of U.S. intermediate government bonds and real estate, posted positive returns for the quarter, with the S&P 500 gaining the most value at 10.6%. That, of course, is a popular index primarily tracking U.S. large growth company performance. Now we can also see that the performance of each individual asset class tile shows no predictable return or relative ranking from 1 year to the next. It is quite random, as you can see. The diversified index mix, such as the 60% stock, 40% bond mix shown in the white tile, tends to stay away from the extreme returns, both positive and negative, on an annual basis and over time, while also dampening the volatility of returns. This is an example of the potential benefits of a well-diversified portfolio. It also helps as investors to stay in our seats through any given quarter of market turbulence and not take away from our ability to prosper from the many quarters to come. And with that, we have reached the conclusion of today's presentation. Thank you for joining us, and we will see you next quarter.